Robschild. No investment advice. Welcome to the show where we view financial markets using Ben Graham's investment philosophy, macro, technicals, and crystal ball gazing. Today is Thursday, October 31st, 2024. Today's episode, we start by bringing up the personal consumption expenditures. This is how much people are spending on stuff year over year. We're all the way down to a 2.1%, very close to the Fed target of 2%. However, the core, excluding the volatile food and energy, came in at 2.7%. So not quite there, but it came in basically as the market was expecting. It was a interesting day. We had, the initial jobless claims actually coming off cooler than expected. And by cooler, I mean there were less initial jobless claims than what the market was predicting. It was a lot cooler than what I was thinking myself, for sure. Now, whether the books are being cooked for political reasons or not, I don't know. So I just have to go off what the chart says. So if we go over to Fred and look at initial claims, 2 weeks ago, I was talking about us being at multi-year highs in initial jobless claims. People that are making initial jobless claims on a weekly basis. I was like, okay, is this it? Or was this what the Fed was talking about when they were like, oh, we don't want to see any further cooling in the labor market? Was that the number? I was thinking, okay, we're going to keep going up from here. I don't think I was alone on that. And instead we cooled off, for a week. I was like, oh, maybe that's just a dip and we'll keep going up. Nope. Another week we went down. And then this week as well, we hit a lower low. If you look at it from just a basic chart standpoint, you have a lower low, and now a lower low. This is almost like a trend going to the downside at this point. So this, further coolness in the labor market, I'm starting to scratch my head a little bit here, wondering, I think maybe Powell doesn't want to maybe get markets too excited about the cuts, because remember, folks, as much as we're cutting right now, the market, the Fed funds rate is still restrictive. It's still choking the economy. We're still trying to slow it down where we stand. The front end of the curve is above the rest. The 3-month treasury, for example, is also a decent amount above the 10-year. We had the reversion between the 4-year and the 20-year recently, but as it stands, we're still strangling the economy here. And so, as inflation does appear to be, going towards 2%, it makes sense to at least choke it a little bit less. And that seems to be what they're doing. The whole labor market weakness narrative, I am confused by this. I mean, maybe it was the Somme rule that just flipped a switch in these people's brains, being like, well, every time it, flipped before, it became very problematic very quickly. I mean, maybe that was it. I mean, it triggered in July. I don't really know, but, and of course, this is only one weekly report. And of course, we have tomorrow with the most important number regarding employment as a leading indicator, employment and the unemployment percentage. Now, the last reading of this was a 4.1%. The market's expecting 4.1%. It will be very, very interesting to see what it is. Also, just because initial jobless claims is, going down, the continued claims has been elevated, along with the fact that, the unemployment number is how many people want jobs that can't get them. And, so how many people are that, maybe were retired are trying to get back into the labor force because of the fact that, prices of so many things have gone up. So that number could really be anywhere tomorrow. I mean, you probably noticed that markets went down today, the S&P 500, and pretty much everything, well, not everything, but the stock market generally went down today. Now, normally that might be, a reaction to the initial jobless claims being cooler, maybe there's less, bright cuts coming, but the Fed funds futures, at least for November, December, didn't really change at all. We went flat here. I'm not really sure what the driver was of the sell-off, other than the market simply being overly expensive and maybe exhausted here. Maybe Mr. Market is now running on fumes. We'll get through the rest of the charts in a moment. Daily reminders, nothing's changed. I made a special separate daily reminders video on Monday. These are things that are important, I believe, to be thinking about in the back of your head on a daily basis and to not forget as we get further past the SOM rule, further past all of this data coming out. It's easy to forget that all of these things exist and are yelling at the tops of their lungs that there's a major slowdown coming. And with nothing changing in the daily reminders today, the crystal ball reading remains the bear market will be coming very soon, and the Fed won't cut fast enough to save the economy. Again, if you want to see me walk through all of the daily reminders, watch Monday's separate show. I only do that on Mondays. I love all of the likes and comments, and I've been getting some great donations lately. I really appreciate all of you guys. Feel free to support the channel any way you wish. Onto the charts, we'll start with the S&P 500, the SPX. We finally cracked below. We did it. No matter how you draw this line, people say we already, cut the line. We already broke out of this maybe a while ago, maybe yesterday. I mean, even if you just connect these two lows here, anywhere you put the line, we broke majorly to the downside today out of this rising wedge in the S&P 500. This is a very bearish move. I would expect this to continue downwards just on a charting basis without even knowing what's going on in the economy or SOM rule or, yield curves or whatever. If this was a stock chart, and you were just, doing the whole thing where, you just trade the pattern and you ignore everything else, because these things do play out with good probability. This is very bearish looking. The S&P 500 looks like it's going to be falling apart a little bit, at least for a little while here. It's funny, the last day of October, everyone's talking about how September and October were like, oh, we made it through it, guys. It's almost like, yesterday it was like the final sigh of relief, and then finally the market decides to dump on the last day of October. Highly interesting stuff. The VIX popping up to the upside today at 23. This price is options contracts. This is known as the fear gauge. Anything above 20 is saying, yeah, this is fearful here. It's been saying fearful for a while, and so finally the market cracked to the downside. I mean, you don't need a crystal ball to have predicted this down move in the S&P 500 here. Yeah, that pattern was just so obvious to every single person out there. Anyone that's looked at it, that knows anything about chart reading, saw this coming, and it finally came today. And so with very elevated VIX, obviously the front end of the VIX futures curve is very high above the rest. Again, it was high above the rest this whole time. It was saying the market's gonna fall apart here. This entire time I was saying it, everyone was saying it. So it finally happened today. If you've been following the show, I've been talking about SMH, the semiconductor ETF, looking like it was forming this wedge, very similar wedge pattern to the S&P 500. And I've been saying it's, because of this bearish engulfing candle, along with previous bearish engulfing candles, 3 of them marking major downsides. This double one was a real doozy. This is, according to one chartist that I have a lot of respect for, it says the rarity of a double engulfing candle at the very top of a market is like a white whale kind of a situation. Something you search for your whole life and only see maybe once. And so the stars are aligning with the highly overvalued semiconductor industry, the tree that grew tall but didn't grow forever, because trees don't grow forever. We are in this head and shoulders topping pattern. It looks like it is about to play out like clockwork, as I've been predicting on this show with my crystal ball and all for quite a while now. If you are holding the fund SOXS, as I have been for the past 3 or 4 days, you got a nice little prize today of 12% jump in the price of this fund. So that's quite a handsome reward. Although I'm going to hold it because I think this is going to keep falling apart here. We'll see how it plays out moving into the future. Amazing how we were, I believe yesterday, yeah, it even says right here, previous close, we were still in greed mode. We skipped over neutral today, slamming straight into fear in the CNN Fear and Greed Index. Mr. Market, I believe I said yesterday, that Mr. Market was rubbing his eyes a little bit, saying, "What's going on?" And he woke up and realized that he's maybe running on fumes. And anyway, long story short, we're in fear mode now. Unfortunately, the high yield or junk bond spread, so how much debt costs for non-investment grade companies to borrow money, this thing can be anywhere between 2.8% and 20%, when the market's really fearful, these get very, 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 very cheap. And we don't have, unfortunately, today's update. This stays 1 day behind. This is yesterday's day at 2.8% credit spread between junk bonds and treasury bonds. Now, with today's drop, obviously, this will have spread out today, so we'll see how that looks once that's added to the chart. But I can't not bring this up because of its importance. To be anywhere below 3% is fairly rare. This chart going back all the way to 1998, there's only very brief periods where we're ever below 3%. And then, for example, May of 2007, no one thought that junk bonds would be problematic, that they'd be going, that they'd default, that the companies issuing this debt might go bankrupt. It was 2.46. This was right before the great financial crisis, and then bond spreads between junk bonds and treasury bonds spread to 20%. There are folks buying junk bonds right now, assuming there's no risk. And when I believe this is one of the most risky times in maybe all of history to be buying junk bonds. But remember, I'm just a guy with a crystal ball. Last few charts, we're going to look at TNX. This is the 10-year Treasury note yield. I noted yesterday how we had broken below this rising wedge. A lot of rising wedges lately in markets, right? Today, we're holding the line below this line still. It will be very interesting to see if we can climb higher here in yields. If I had to guess, I'd say this is probably rolling over here. I bought more TMF today, by the way. If you're new to the show, I have about 50% of my own portfolio exposed to, we'll call them leveraged long treasury bonds. My strongest argument for long treasury bonds doing well, specifically right now today, is the fact that the S&P 500 has a PE ratio of 30 and treasury bonds are over 4% right now, which is a major mismatch in terms of valuation between the value of bonds and stocks. Stocks are massively overvalued compared to the value of bonds right now. And these things cannot, they can't like physically keep going like this. It's sort of like a situation of gravity. Like you can try to fight gravity for so long before, it just takes over. So I think being in treasury bonds right now is sort of like assuming that when you drop a rocket, it will fall to the ground. Again, no advice on this channel, and I am a guy with a crystal ball. And it's not even real crystal, it's just glass, so, careful out there, guys. The most common typical way most investors get exposure to long duration treasury bonds is through TLT. I use 0, ZN, TMF, and options contracts. But TLT is the one to check as far as, chart patterns go and such. So, as you can see, we're no longer like just going down and down and down and down. We're at least pausing here. Can it keep going down? Yeah. Can this be a bottom? Yes. I would guess that at this point, with the S&P 500 finally cracking here, there should be a little bit of run to safety into bonds at this juncture. This recent down move in TLT could be the last shakeout of all the bears before we head higher. But that's just a crystal ball reading. 12% of my portfolio is exposed to KWEB. This is a ETF that holds a collection of Chinese companies such as, the China version of Amazon. It's not Amazon, it's their Amazon. JD, Baba, Baidu, all of these internet commerce, social network platforms, all that stuff is in this fund. I believe that these companies are massively undervalued, and so owning them, I think, it's a great time to own them. It's like, to me, it's blood in the streets cigarette, but cheap. I believe a fair low value for this fund of KWEB is around the $45 to $50 range, which is where I would be selling out. That's not because of anything to do with the charts. It has to do with the actual valuations. And so I'll sell out there when and if we get there. But anyway, I talked recently about how we broke to the upside out of what looked like a wedge. And instead now it looks like this is turning into a flag, which means actually it's a bear flag. So we went down and now we're flagging out. And so the most probable move for a short-term charting anyway would be the downside. I don't know where it'll go from here. Obviously, I'd benefit if it goes up, but I can be patient with this. I do believe, Benjamin Graham always says, that you shouldn't worry too much about political risk. Certainly, it's not a good idea to buy foreign government bonds, but stocks, like owning the ownership of companies, is different because, say the country has a major inflationary period. Well, that means that the prices of everything goes up, but it also the valuations of the companies goes up in their currency. And so the value of companies doesn't change much for you. They still produce the same things that are worth, on an international level, the same amount of money. And so it's important not to worry too much about political risk and realize what a stock is. It's the ownership of production. It's the ownership of a company making stuff, making goods and services for people. And that's what runs the world. And you get to own what's running the world. And so I think what's been sort of keeping this, holding this market down is people worrying about political risk. Of course, political risk does exist if some major war broke out or something like that. That's where the risk comes in. I think the market's been overly fearful here to the point where, the prices have been so suppressed that it's been kind of ridiculous. So I'm just waiting for the balloon that's been held underwater to just rise to the surface. That's all I'm asking for. I'm not asking for it to go to the moon. I just want it to get to the surface of the water. And that's all from me and my crystal ball. Hope you enjoyed, and see you tomorrow. Watch out for that big unemployment report tomorrow. It could really be a huge report, or maybe nothing at all. Robschild. Actually, that's all. Thank you for watching. See you next time. Robschild.